Hello traders. In this video, we will give you a quick overview of candlestick patterns. Here are some things which you will know by the end of this episode. What are the classifications of candlesticks? What are the functions of candlesticks? How candlestick patterns can be used? Important candlestick principles. Context of a candlestick pattern. Principles of continuation patterns. And lastly, principles of reversal patterns. Candlesticks can be classified by the number of candlesticks or direction of candlesticks. The first type of candlestick is a single candlestick, the second type is a double candlestick pattern, and the third would be a triple candlestick pattern. A triple candlestick pattern would be stronger compared to a single candlestick pattern. If you are a beginner, we recommend learning single candlestick patterns first, followed by double candlestick patterns, before moving on to triple candlestick patterns. Candlesticks can also be classified by its direction. If a continuation pattern appears, the market is likely to continue in the same direction. If a reversal pattern appears, the market is likely to make a reversal. Candlestick patterns can tell you a wide variety of things. It tells you the short-term market sentiment. Markets are driven by fear and greed. It can be used to determine trend strength. For example, if a continuation pattern is seen in the middle of a trend, this implies that the strength is relatively strong. It can be used to spot potential reversal points and market retracements. Lastly, it can be used to determine entry and exit points. Now, I will show you an example of how candlestick patterns can be used. This is a level of support. If you see a bullish engulfing candlestick pattern form, should you enter short? The answer is no. Bullish engulfing is a bullish reversal pattern. Time for another example. If this is a level of support and you see a bearish engulfing pattern form, will you enter a long trade? The answer is no. Bearish engulfing is a bearish pattern. Do note that candlestick patterns are best used alongside other conformations. Let's move on to some important candlestick principles. Not all candlestick signals are equal. They may look the same. However, depending on the context, one pattern may be stronger than the other. The length of the candlestick's wick matters. For some candlesticks patterns, you need to take note of the size and color of the candle's body. Context determines candlestick pattern strength. We have to use other conformations to spot false signals. One cannot rely on candlestick patterns alone for trading. Let's elaborate on the context of a candlestick pattern. Where did this candlestick pattern appear? Did it appear in an uptrend? Did it appear in a downtrend? At the start or end of a trend? You can have the best candlestick formation. However, if it appears at the wrong place, it will not be a successful trade. We need to take note what comes before the formation of a certain candlestick pattern. Lastly, the time frame of the candlestick pattern. The higher the time frame, the stronger its strength. This also applies to other indicators you may be using. Candlestick patterns formed higher time frames like the hourly or 4-hour will be much stronger compared to a candlestick pattern formed on the 5-minute time frame. Here is an example of how we should use candlestick patterns alongside context. If there is a preceding downtrend and we see the formation of a bullish Harami candlestick pattern form at a level of support, this tells us it is likely that the price will bounce off support. We will now show you an example of continuation patterns. 3 white soldiers is a bullish continuation pattern, while 3 black crows is a bearish continuation pattern. Here is an example of how they look like. Principles of continuation patterns. Sometimes, reversal patterns can become continuation patterns. Continuation patterns can also become reversal patterns. Continuation patterns can be used to determine an entry or exit point of a trade. For example, if you are in a long position and you see a bullish continuation pattern, you can continue holding the trade. Continuation patterns work best at the start or middle of a trend. Let's talk about reversal patterns. Some examples of bullish reversal patterns are doji, hammer, bullish engulfing, bullish Harami, and morning star. Some examples of bearish reversal patterns are doji, hanging man, bearish engulfing, bearish Harami, and evening star. Take a moment to look through how some of these candlestick patterns look like. If you are a beginner and these look confusing to you, not to worry. We will be posting comprehensive candlestick tutorials soon. Principles of reversal patterns. Reversal patterns work best near the end of a trend. They also work best after a sharp rally or sell-off. Reversal patterns can be used to determine when we should exit a trade. As always, we need to use other confirmations to spot false reversal signals. For example, we have a trend line. We see a trend line breakout with this candlestick pattern. If you have been paying attention, you will know this a bearish engulfing candlestick. Let's see the results. You have reached the end of this episode. Please like, share, and subscribe.